Okay, this is Group Four's case study of Cadbury Schweppes. And as a group, we argued back and forth about whether we should bid or not bid for Adams. And we liked how in the case Chief Strategy Officer Todd Spitzer thought it was a bet the company move. It would either be foolhardy and possibly put the company itself in peril, or it could be a once-in-a-lifetime opportunity that sets them up for years to come. And after going over all the facts, we decided that we would recommend approving a bid to purchase Adams. And there were really just three areas that we focused on when coming to that conclusion. That was strategic fit, were there more pros than cons, synergies, more important, unique synergies, and overall numbers, finding the cost advantages, and just going over the different numbers that we had available to determine the right bid. Because even though it was a good move for the company to make, it wasn't worth going all in and bidding too high.
Some of the strategic fit and strategic advantages that Cadbury Schweppes stands to gain from the acquisition is they're acquiring a high margin product. Gum is high margin, and the market for sugarless gum, which Adams excels in, is expanding. Sugared gum, which is Wrigley's strength, seems to be shrinking as consumers are more health conscious. So that poses Cadbury Schweppes an opportunity to increase their market share while stealing it from one of their biggest competitors in Wrigley. They would also acquire trade secrets and proprietary information from Adams that they could combine with their own information and recipes to create new products and unique products and further gain market share by introducing new things into the market, as well as they'd be able to extend their global reach by consolidating their regional facilities and their regional supply chain operations. They would be able to cut costs while also expanding. They're able to consolidate while still growing outward. We do have some concerns, one of them being conflating similarity with synergy. Just because the two companies are in the confectionery business doesn't mean that everything is a match side by side, and they need to make sure that they have a solid strategy that they keep with it, focusing on that global market rather than losing sight and going after short-term profits that in the end won't justify the expense. They also need to be aware of the non-immediate cost savings that comes from consolidation and closing down plants. So when they see the balance sheet isn't where they wanted it to be or where they expected it to be, they need to stick with that course through 2 or 3 or 4 years and see it through that time period to gain that full benefit and cost savings.
Most of our group were pretty skeptical based on case A of Cadbury's ability to take on Adams and make this a successful venture. However, case B presented the various synergy plans presented by the merger and acquisitions team, and we found several of those compelling. Among those, the intellectual property has been mentioned that Adams has. This coincides with their research and development culture. Certainly product diversification with sugarless gum, as well as other products and other markets that Adams has a presence in, or at least is established in, is obviously a synergistic venture for Cadbury to acquire. And then a fairly obvious one would be supply chain consolidation. We did note that some of the synergies presented by the team were not necessarily unique, such as sugar sourcing and perhaps part of the supply chain consolidation. Office consolidation we were doubtful of, frankly, because Cadbury had failed to consolidate offices within 20 miles of each other within their existing organization prior to any merger attempt. Global media buying and IT consolidation we also found to be skeptical plans, simply because they are massive undertakings that may tax the organization beyond what it is used to enacting in terms of change management.
In the end, our recommendation to the CEO and board of directors is to bid $4.2 billion on Adams. We see the bid price supported by the following. The estimated value is $3.5 billion on the high conservative end. Therefore, we're suggesting a premium of $700 million being paid for Adams. Analysts have estimated total synergies to create a value of $5.6 billion, and looking at the internal merger team analysis, they have suggested $3.6 billion in total synergies. At first glance, this seems like a no-brainer. If Cadbury Schweppes is able to get $3.6 billion in value of synergies for basically $700 million, this is a great value. But like we've noted before, that being said, based on the case, we're unable to understand which synergies are unique to Cadbury versus the other bidders. And those are the only synergies that we should consider in the final bid price. And because we were unable to identify unique synergies throughout all of the synergies identified by the internal merger team, we took a conservative estimate of realizing 25% of these synergies. Therefore, the 75% haircut equals a $900 million in realized synergies. And this haircut supports a $4.4 billion bid. In the end, we discounted this slightly to come up with $4.2 billion, and that is a suggestion that we will make to the CEO and board of directors.